Welcome, my assets viewers. Often we are try to bring a fund manager to our talk to get a broader view about the market and other stuff. This time we are representing Mr. Satish Ramanathan, CIO, Equity JM Mutual Fund. He has a vast years of experience. He has put 30 years of experience. He worked in ICRA and then he worked in ICICI Securities. He was a fund manager with the Franklin Templeton, and he was a director equity Sundaram Asset Management. He was fond of getting into the equity market. He started his own entrepreneurship, Tatva Capital, long back. From there, his journey into the equity market has started. Now, I am planning to present you Mr. Satish Ramanathan with a lot of questions which you probably running inside your mind. Welcome, Satish Ramanathan.
Welcome. Thank you. Thank you for having me on your TV show. I look forward to meeting all your viewers.
Yes, sir. I just want to start with the first question because everybody is talking market is high, market is high. What is your view of the current market situation?
The overall market is high, yes, and we are also cautious. We think the earnings have not been too great and there is a scope for some correction to take place, and hence we think investors should be cautious here.
Sir, now that first quarter results have started to come, so what is your take on the first quarter results? A lot of people are saying it's a mixed bag. So what is your view on this, sir?
The first quarter results have been mixed. It is correct. There has been some disappointment in the chemical stocks. There has been disappointment in some of the infrastructure stocks as well, and manufacturing stocks. There have been shortages in certain key components, and some export markets have not picked up, such as Europe, etc. IT sector has also given some disappointing results.
So now you said it's a mixed bag. Going forward, which are the sectors you are likely to be bullish, and why you are going to be bullish on these sectors, sir?
In the sectors which we are turning positive right now, we are looking at local economy stocks. We are looking at infrastructure names. We are also looking at domestic consumption names. We expect some recovery in rural India, and therefore we are looking at domestic consumption names also.
So these any specific sectors you want to talk about, like IT, pharma, auto, financials, like that, sir? You want to say that with that which are all you are likely to bullish?
In terms of IT and pharma, they are defensives, but they are facing business challenges in their key markets, which is the US market, because US market is slowing down. We have just had a small financial crisis in US with the Silicon Valley Bank problem, and therefore smaller banks are struggling there, and they are not investing in IT and all these kind of extraneous projects. So US market is challenging for IT sector, which typically accounts for 1/3 of overall exports. As regards pharma, again there is price competition in the US market, and therefore we are cautious. But IT and pharma generate a lot of cash flow and do not borrow, and are not as volatile as some of the economically sensitive sectors. So we prefer to keep some weight in IT and pharma, but we are not overweight.
Now you are talking about the US recovery that is going to be the prime cause for driver for IT sectors. What are the indications you look for the turnaround in the US market which is likely to aid the IT sector, sir?
In terms of the US market, I think the US market is also having certain issues such as the slowdown and the higher interest rates, Fed interest rates. So till the slowdown does not stop and we see slight recovery in projects and businesses from US, that is the time we will turn positive on the IT sector. Also, we have a key aspect in the IT sector, which is the AI and how it can change the IT sector. Many of the old businesses can be disrupted due to AI, so we are watching that also.
So now we saw that, sir, you spoke about the broader sectors, and now we saw that the mid and small cap have really given a fabulous return. That 1 year mid cap return, some of the funds are given around 50, small caps have given 55% of return, 1 year return, and lot of funds have been given in the range of between 35 to 45% are given in a small cap. Similarly, when you look at a mid cap, there are the average returns have become 28 to 29% is the average return of the mid cap segment. There are mid cap funds has given which is size, there are big in size, but they are able to deliver 40 to 43% of returns. So the investors are very crazed to invest in mid and small cap. I also see that in the June month there was a lot of huge flow happened in a small cap, close to all time high could be called that. That's where the flow based on AMFI records. So now what is your take on the mid and small cap, sir?
Mid and small cap segments typically provide higher growth. It is also a function of the economic cycle. If you take a slightly longer time frame of 5 years, mid and large cap and small cap all returns converge, and the difference is not that much. In the current economic cycle, because mid caps have turned cash flow positive and are also growing considerably with improved margins, mid cap stocks have been re-rated. But over periods of time, based on economic volatility and market volatility, large caps may outperform, mid caps may outperform. That is from a stock perspective. From a growth perspective, mid caps have a longer growth runway, which means that mid caps actually deliver higher compounding returns if you get the right sector and the right stock. We have seen mid caps deliver sustainable growth for a meaningful period of time.
So now there is a concern for you mid and small cap at this point in time, or if people can take some profit out of mid and small cap since the fund has given 30-40% of return, those who have entered in the last 1.5 years time, or you can advise them to stay invested, not to book profit?
It depends on the type of stocks that they have invested in the mid cap space, because mid caps also have a lot of commodity and commodity driven stocks such as plastics and chemicals and things like that. So these sectors may turn volatile from here on, but consumption sectors stocks and also stocks involved in longer term growth trajectory areas such as paints, hotels and services are preferred sectors in our view. But we should be cautious going ahead.
Now you spoke about the IT related stuff and then pharma, all that you have been telling about that. So always an investor, they don't want the bits and pieces, they want a collective answer from that. I don't want to ask initial first question itself market outlook, because the people will not get, the investor community will not get a broader view of that. That's why I kept quiet with that first question. Now I just want to put you that bouncer question, that what is your view on the market outlook from here on?
So the earnings have been patchy, which we have discussed earlier. So therefore we think market will be little range bound from here on. There may be little bit of drawdown and cooling off also, but structurally market is safer because we have money coming in from retail investor, we have money coming in through SIP, we have money coming from the mutual fund industry, and we have EPFO investment as well. So structurally equity market is not as volatile as it used to be in the past. Bearing this in mind, investor has to be little more cautious and use SIP, STP route to build the portfolio from here.
So now I just want to ask one question. Now you said SIP, STP, all that you said that. As I'm just coming a new investor to the equity market, what strategy I should use? And existing investors, do you recommend a profit booking, sir, at this point in time?
Profit booking is always at the discretion of the investor, providing he can find a better use for his money. But in our view, equity assets still offers the best liquidity, best tax advantage for assets, and any other investment is not as tax efficient as the equity investment. So unless there is a need for money, we would advise investors to continue with equity funds, but change allocations little more dynamically. One. Second, for a new investor, at this point in time, one should probably look at large cap allocation, increasing large cap allocation right now, and keeping mid caps and small caps as the smaller allocation. Upon some stability coming in the market, we can quickly change allocation from large cap to mid and small cap and grow the portfolio.
So normally whenever we do an interview with the fund manager, we avoid talking about their funds and their performance because our outlook is only to give a broader view for our investors. But I'm slightly little tempted this point in time to bounce your question because we saw that your performance of some of the funds, for example, the value or the flexi cap or equity hybrids have really done exceedingly well and they are in the top 1, 2, 3 positions. Is it really, what strategy you adopted to bring your funds in the top after quite long time?
We have inculcated a strict discipline in our portfolio. We are growth oriented investors. We look at growth of the earnings and earnings quality. We call it the geek philosophy. And the growth in earnings we follow with a very rigid view. Now, growth in earnings can come due to the sector doing well or the company doing well in this sector. Whatever the reason is, the company has to deliver on earnings growth. So, we are patient investors, but if there is a structural problem in the business, we quickly make an exit from the portfolio. One. Second, we are also looking at the quality of investments and quality of cash flows that come from the business. If the company is not generating cash flow or is over investing and not keeping fiscal discipline, then also the portfolio does not look at these stocks. So this discipline has helped us maintain a good growth in our capital because of this reason.
Thanks, sir. I think you have given a very broader view about the markets and which of the sectors we and investors should take a look at. I hope investors, you would have taken a lot of inputs he has given it. Please analyze these inputs and see that how we can able to fine tune your portfolios. And as he suggested, some of the investment strategies for investors coming new or the existing investors, please follow that. And an investor not attending or listening to such a video had not been fulfilled unless you implement it and try to make money out of that. That is where the benefits you enjoy, because when investors you send a comments or feedback to us that based on video we are become more disciplined investors, we really looked at how the market should be or all the knowledge you got it, please use it. Unless you are not using it, it doesn't turn into wisdom. The knowledge turns to wisdom and you start implementing it. Lot of input he has given, please use it and convert this knowledge into wisdom. Thanks viewers for watching this video. We'll see in another video with more better information. Bye then.